Welcome back to another video. If you're stopping by the channel for the first time, please consider subscribing to my channel. And while you're at it, smash that like button for me. I really would appreciate it. Also, hit that post notification bell so that you're notified every time I upload a new video. Be careful down in the comment section of the videos. A lot of spam, a lot of scammers. I will never ask you to contact me by WhatsApp or Telegram. I also do not invest money for my subscribers, so please be careful. Don't get yourself scammed. If you want up to 12 free stocks, Webull is going to give you up to 12 free stocks when you open a new Webull brokerage account. Put any amount of money in that brokerage account. They're going to give you up to 12 free stocks for just trying out the brokerage app. There's a link down in the description box of this video. Go click on that Webull link. Open up your new Webull account today. Go get that free stock. Go get that free money. I'm also going to send you a Webull tutorial video. All you got to do is send me an email when you open the Webull account and you fund the Webull account. And then I'm going to go ahead and send you that tutorial video that can walk you through how to use the Webull app to make your first trade. There's an email address down in the description box of this video. Go click on that Webull video, and then I'm going to go ahead and send you that video. Well, guys, here's the deal. We just got the November jobs report, and I want to go over some of the key points in that jobs report. Why is that critical? Well, you know, if the labor market is overheated, then potentially the Fed may have to continue increasing short-term interest rates. So the jobs report is really, really important. That data will help the Fed determine if they need to keep increasing short-term interest rates. Now, you got 5 key points that I'm going to touch on as it relates to the November jobs report. So let's go ahead and get started. And I got some information here from a Bloomberg article that I read that kind of capsulizes these 5 points real quickly. And then we're going to move on and talk about some other data that's going to be coming out next week that we need to pay attention to as well. So let's start with jobs. The data came in better than expected. Now, I said smashed in the title, but it came in better than expected, with signs of strong labor market across the board. Payrolls rose 199,000 in the month, more than the 185 average estimate of the economists. So what does that mean? That means your experts out there thought that the economy would add 185,000 new jobs. But in actuality, the economy added almost 200,000 jobs. So it beat expectations, right? It smashed expectations. The unemployment rate tightened to 3.7%. That's a pretty low unemployment rate, guys, right? So more jobs being added to the economy means, in most cases, unemployment goes down because more people have an opportunity to get a job. The more jobs are added, the more opportunity people have to get a job. So that typically does push down the unemployment rate, right? And that's below forecast and is a 4-month low. Keep in mind, unemployment rate low, 200,000 new jobs added. The Fed may not really like those types of numbers, not when you're trying to get consumers to stop spending so inflation can come down. You get where I'm going with that. And then the participation rate ticked up to 62.8%. Weekly hours also rose, a sign of demand. Now let's go to point 2, average hourly earnings. Guys, this is important. This is a big one right here. Average hourly earnings rose 0.4% from the prior month, matching the high estimate from analysts. This is great for workers, but a troubling sign for the Federal Reserve as they seek to cool inflation and spending. See where I'm going with that? Adding 200,000 jobs, unemployment rate goes down. On top of that, wages go up by 0.4% over the prior month. That's a problem for the Federal Reserve, guys. That is a major problem, right? Let's go on to number 3. Job gains were led by healthcare, government, and manufacturing, right? Payrolls got a 30,000 boost from the auto workers returning from the picket lines. So of the 200,000 jobs that were added, 30,000 of those jobs came from UAW, United Auto Workers, coming back to work. And why did they come back to work? Because they got the things that they wanted in a compensation package that they were demanding from your large major automobile manufacturers. These people have a union, and when they felt like they were not being properly compensated, they striked. They went off the job and they held out until they got something that they could live with. And you had 30,000 of those people come back on payroll. So that was 30,000 of the 200,000 payroll jobs that were added to the economy, right? Let's keep going. Government hiring was led by state and local bodies, right? Still higher than the government, though, even though I don't think we still have a government funding bill. Now, we may have, and I may have missed that, but we're still hiring in the government, right? So both state and local bodies. Okay, not federal, but state and local. So I get it. But still, we added some jobs in the governmental agencies, state and local. And we've seen healthcare gains were driven by demand in home care, right? So as people need people to come into their home and help them out, that boosted healthcare, right? And then payrolls also got a boost of 17,000 from the resolution of the Hollywood labor dispute. Remember, in Hollywood, folks were going out on strike, right? They were demanding more of a compensation package and from what? The major Hollywood studios. Those people came back. So if you take UAW and then you take Hollywood, you add those two together, you got 47,000 folks came back on payroll of the 200,000 that was added to the economy. And we'll touch on that later and why that's important, in my opinion. This report, especially if its kind of strength is repeated in December, hear me out now, complicates the Fed's outlook. Why does that complicate the Fed outlook? Well, let's keep reading. Payrolls and labor demand were expected to start slowing, but the opposite happened. What this report makes clear is that the labor market is strong. Consumers are in a great place to keep spending, and there are a few signs of recession, at least judging by job data. There's that recession word again, and why? It clearly states here that a strong message, this labor report has sent a strong message that the labor market is still strong. That's not good news for inflation, guys. That's not good news for inflation. Because you know, as well as I do, when the American people don't have concerns that they're going to lose their jobs, guess what they do? They keep spending. Wages went up, right? Unemployment going down. They're going to keep spending. And that's a problem for inflation. And that's a problem for the Federal Reserve. So yeah, that's interesting. That's interesting. S&P 500 and the NASDAQ futures initially plunged in the minutes after the report was published, before moderating as markets digested the data. Two-year Treasury yields rose about 9 basis points earlier. So when the data came out, the jobs report data came out, the S&P and the NASDAQ dropped. The futures dropped, right? Because the market wasn't open yet. But the futures dropped, which is an indication of what the market's going to do when it opens, right? So not good news, man. Now, since then, the NASDAQ and the S&P have moderated. They've leveled out. But that was shocking, man. I mean, you talk about investors thinking we're out of the woods. The Fed gonna stop increasing short-term interest rates, and then boom, you get a report like this. You get a labor report that says, not so fast, not so fast. Here are 200,000 new jobs when the experts thought we would only add 185. Also, here's something else we're gonna throw at you. Unemployment rate goes down. Here's something else we're gonna throw at you. Wages go up from the prior month by 0.4%. So not only are you adding new jobs to the economy, but people are still getting wage increases. The data's right here. So that's important, guys, because next week, guess what's happening? Fed gonna be meeting next week. They're gonna be meeting on December 12th and the 13th. Guess what else is coming out next week? November CPI inflation report. So the Fed has a decision to make, man. You just got the jobs report, and it wasn't. It's not good news for inflation. It's not in good news for inflation, right? And they're even saying recession again, right? It's this labor market continues to be strong and resilient. The only way the Fed will be able to control inflation and not have it go back up is if they keep increasing short-term interest rates, which could do what? Could throw the economy into a recession. That's basically what this article here from Bloomberg, or at least the cliff notes of the article, is saying. That's scary, guys, because we thought we were out of the woods. I thought we were out of the woods. I've made plenty of videos over the last week or so saying Fed ain't gonna increase short-term interest rates anymore. I don't know, guys, especially if next week on December 12th, when the November CPI inflation report comes out, if that's bad news, guys, they may increase on December 13th. They may, I don't know. We'll have to see. But that data is important, very important, because if the Fed believe that our labor market has not cooled off. See, I thought it had cooled off because when you look at the high water mark in January of 2023, they were adding, 400,000 new jobs. And then, it just kept coming down. Last month, it only added 150,000 new jobs. That was last month in October. And then it comes back this month and exceeds that. Now, keep in mind, we also got to take in consideration UAW and the Hollywood strike. So you got the United Auto Workers strike, and then them folks in Hollywood, they were striking. So that's 47,000 that goes into that 200. So if you take that out, if we take that out, then it's much better. It's much more manageable. It's about what it was last month, right around 150,000 new jobs being added if we take out the United Auto Workers rejoining the workforce, and then if we take out the 17,000 from the Hollywood strike. If we take that out, we're basically where we are in October, which is much better. So I wouldn't say panic because of that. If we take that 47,000 out, I think we're back to where we were in October. So hopefully, that's what the Fed will look at when they meet next week. Hopefully they will say, something, those numbers are a little bit skewed because I don't want, the United Auto Workers, the 30,000 jobs that were put back on payroll were not really new jobs added. They were old jobs that just were vacated for a little bit. Now they're just back on payroll. Same thing with Hollywood. So I'm hoping that's the posture the Fed will take when they see this data. Well, obviously they've already seen the data, but hopefully they will take that in consideration, that it wasn't, you know, legit 200,000 new jobs. Really, it was like 152,000 new jobs, and another 47,000 came from old jobs that just went back on payroll. Now the kicker is, here's the thing you got to really think about though. The kicker is, you know, hourly wages, like it says here, average hourly earnings rose 0.4% from the prior month, matching the high estimate from analysts. This is great for workers, but a troubling sign for the Federal Reserve as they seek to cool inflation and spending. That's a concern, because these wages keep rising, right? That's a concern to me, more so than the 200,000 new jobs being added. That number is a little bit, got to put an asterisk next to it, right? Because of the 47,000 that just came back on payroll, that were already there. They just came back on payroll. But really the one that's troubling is the 0.4%. Now, keep in mind that 0.4% in wages, remember, UAW got a big compensation contract, right? Obviously, the Hollywood workers, 17,000 of them, they must have got what they wanted. They're coming back on payroll. So maybe that increase in compensation from those 47,000 may have skewed the average hourly earnings 0.4% over last month. Maybe that goes in there too. So, you know, the Fed gonna have to look at this data and kind of figure out what it really means. I tend to think it's skewed because of the 47,000 workers coming back on payroll. They were already employed. They just had been on payroll because they were striking. Now they're back and they're added back to payroll. So that might have skewed things a lot. So we have to wait and see on that. But we also want to pay attention to next week when that November CPI inflation report comes out. Be curious to know sort of what that's going to look like. But let's take a look one more time at the outlook, right? This report, especially if this is the kind of strength is repeated in December. So basically what Bloomberg, the person who wrote this article, is saying is, if in December, and we won't get to December's labor report until when? January. So in January, when we get December's jobs report, if it's equally as strong as November, then we got a problem, right? We got a problem. Houston, we have a problem. That's basically what they're saying. Let's read on through this. This report, especially if its kind of strength is repeated in December, complicates the Fed's outlook. See, the Fed's outlook right now, prior to this, the Fed's outlook was what? We're going to pump the brakes. We're not increasing short-term interest rates anymore. We believe inflation is coming down. What we've done, 0 to 5.5% Fed funds rate over the last 20 months has worked. Now we're just going to wait and see how the economy adjusts to that. See how inflation adjusts to that. Will it continue to come down? That was the outlook. And then sometime in 2024, we start reducing. That was the outlook, right? That's why they're saying it complicates the Fed's outlook. Payrolls and labor demand were expected to start slowing. Well, maybe it is. Maybe it isn't. We'll know in December, right? We'll know when we get December's report. If we repeat November's excellent jobs report and we repeat that in December, the Fed may have to act sometime early next year. I don't know. We'll have to see. We'll have to wait and see and continue to watch. Payrolls and labor demand were expected to start slowing, but the opposite happened. What this report makes clear is that the labor market is strong. Consumers are in a great place to keep spending, and there are few signs of recession, at least judging by the job data. Okay, they're saying few signs of a recession. But you got to understand, guys, if people keep spending, the Fed gonna keep jacking rates, and you got nowhere but to go recession. Because if rates get so high and cut people off at the knees and people can't spend, people don't have the ability to get jobs, because as you continue to increase these short-term interest rates, at some point there's going to be a breaking point in the economy. At some point, companies are not going to be able to hire people anymore. They're not. Right now, people are starting to hire again in some sectors because they thought or believed that the Fed was done rate hiking and that they were ready to gear up for the rate decrease, which would spur on what? Some demand. So a lot of companies thought, okay, let's start gearing up for next year. Let's start hiring some folks, gearing up for next year, because when the Fed start reducing short-term interest rates, that's going to create some demand. And we want to be in a position to take advantage of that demand. Well, pump your brakes. Pump your brakes. That may not happen. That may not happen. So, yeah, man, it's going to be interesting what happens the rest of the year. It'll be interesting next week when the Fed meets. It's going to be super interesting how that goes. We're gonna have to pay attention and watch that, guys, because what's going to be happening will set us up and give us some indication of how we should be position ourselves to invest going into 2024. It's going to position us and give us some idea what we should be doing. This report shocked me. I'm not going to lie, but when I peeled back the onion and I said, okay, yeah, it's shocking, 200,000 new jobs when we thought we were going to level out like we did last month and be at 150. But when you peel back the onion and you say, hey, of those 200,000 jobs, really 47,000 of them were existing jobs that just didn't have payroll attached to them, right? They didn't have payroll attached to them. Now the payroll has been turned back on those 47,000 new jobs. Old jobs, them 47,000 old jobs, the payroll has been turned back on, and those are thrown into the mix. You take those out of the mix, you're right at the number you were in November, 150,000 new jobs, right? You're right at those numbers. So we gotta take that in consideration too. Really, the true test, I think, will be in the December's jobs report. That'll be the true test. If the economy adds another 225,000 jobs or 250,000 jobs in December, then I think that's when the Fed is going to have to react. I think they'll have to react. Right now, I don't think they will. I think they'll go into their meeting next week, and I think the thought process will be similar to my thought process. Yeah, we had 47,000 old jobs reactivate payroll, and that really inflated the numbers. It also inflated the average hourly wage increase. It inflated that as well. So we're not going to panic because of that, because we believe that report is a little bit skewed. So I don't think they will bump rates next week. I don't think they'll increase rates by 25 basis points. I think they will wait. Until January. I believe they're going to have a meeting somewhere last part of January, I believe, sort of like first part of February, somewhere in there, whenever their first meeting is in the new year. Whenever the first meeting is in the new year, I think that's when, if you get December jobs report that goes up, if you get December CPI inflation report that shows inflation is going back up, I think there's potential opportunity for them to increase short-term interest rates in their first meeting of 2024. I don't know. You will have to wait and see. And obviously we got to take in consideration we're in the holiday season, right? We're in the holiday season. So you're going to see a spike in demand, right? You're going to see a spike in spending because we're in the holiday season. So you also got to throw that in the mix, right? We got to throw that in the mix as well, because people are going to spend money, man, in the holiday season, whether they have it or not, right? Because that makes people feel good. That puts them in the holiday season. That gets them all warm and fuzzy. Yeah, they're going to get them all warm and fuzzy. So people are going to spend money regardless. And so that may skew the numbers, right? That may skew some numbers. That may tick up inflation a little bit. I don't know. We'll see. But I think the Fed will have to take that consideration that we're in the holiday season. So let's not throw the baby out with the bathwater. We're in the holiday season. Y'all know people going to spend money that they don't have. You know it. They're going to get it from somewhere. They're going to steal from Peter to pay Paul. They're going to do it. That's what we do. It's the holiday season. People, this is the one time of the year people want to forget all of their problems and just feel happy. And they do it in this holiday season. So yes, we may see a tick up in spending, which could affect inflation in December, right? Which we're in December now. So right now, who knows what, hopefully, here's what I'm hoping. I'm hoping in December when we get the jobs report, that settles back out to like 150,000 jobs added. If it does that, we're good. No matter if inflation even, let's say inflation in December, because of the holidays and all the spending people are going to do associated with the holidays, let's say that increases inflation a bit in the CPI inflation report for December, but we get a really good jobs report, then I think we're good. What I think if we run into is if we get a jobs report that shows 250,000 new jobs added in December, and then on top of that, we get a December CPI inflation report that shows core inflation jump back up to 4.5%, headline inflation jump back up to 3.8%. You know, if we get two missed reports like that, I don't know, man. The Fed may have to do something in their first meeting in the new year in 24. I don't know. Yeah, it's a lot of speculation, but these are the things we got to think about, guys, as investors, because it's going to position us, right? It's going to position us and tell us what we need to be investing in and how often we need to invest and how much we need to invest. So for me, here's the game plan. No matter what happens, I'm going to keep dollar cost averaging in to my favorite individual stocks and my favorite ETFs. That's the game plan for me, no matter what. I just got to keep doing that. Because honestly, I don't know which way it'll go. None of us have a crystal ball. I just say have a game plan ready for either way it goes. My game plan is just keep investing. Keep buying paper assets as much as I can afford to buy. Blue chip, right? Blue chip ETFs, blue chip index funds, and then blue chip individual stocks. And I do my individual stocks, blue chip, I'm going to do them through the Magnificent Seven. And then I'm going to do VOO, and then I'm going to do VGT, and then VTI when it comes to ETFs. That's it. VOO, VTI, VGT, and then I'm going to do the Magnificent Seven. Those are my investments no matter what the jobs report says, no matter what the inflation report says. I believe at some point in 2024, the Fed still will start reducing short-term interest rates. That's just my opinion, guys. You got to come out and go do some research and come up with your own opinion. But I am of the belief that the Fed will reduce short-term interest rates in 24. When in 24, who knows? But I think it will be in 24. I don't care if it's just 25 basis point decrease in all of 24. They're going to reduce something. I think they have to. I think what you see here in November, when it comes to the labor report, I think that is a jump up because of the 47,000 existing jobs that were there that went back on payroll. So those were added to the 200. They were added to the 200. So I think when you take those 47,000 out, United Auto Workers and the Hollywood strikers, when you take those out, then you got the same thing you had in November. So I'm okay with that. I'm okay with that. I think if you take those out your average hourly wages doesn't go up by 0.4% prior month. That's what I think. I'm gonna be optimistic like that and hope that's what the case is. And then I'm hoping in January when we get these other reports, when we get the December December jobs report, and we get the December CPI inflation report, hopefully those numbers back that up. Hopefully those numbers show us a good sign that inflation's still coming down and that the labor market is not red hot. It's not trying to reignite itself. So that's what this report here from Bloomberg, the Cliff Notes, that's what it was saying. We got to be, the Fed is going to have to figure that out. I don't think the Fed will panic next week. I think, again, I think they will address it, but I don't think it will be, I don't think it will motivate them to increase short-term interest rates. Not at this point. Because remember, guys, they haven't increased short-term interest rates in 4 months. December will be 5 months. And remember, inflation is still came down. So here's the thing. Let's say next week we get the November CPI inflation report. Let's say headline inflation. Now, right now, we know from the October report, headline inflation, I believe, is 3.2%. And then core inflation is 4%. That's from the October CPI inflation report. Let's say next week, when we get the November CPI inflation report, let's say headline comes in at 3% or less. Let's say core comes in at 3.8. I think the Fed disregards the job report, honestly, for November, because if inflation is still coming down and we ain't bumped in 5 months, I just don't think they take the November jobs report too seriously, considering the fact you got 47,000 jobs in there that were already there. They just didn't have payroll attached to them. Now they got payroll reintroduced to them. They come back on the books. It skews the numbers. So let's think about the November CPI report next week. Let's all pay attention to that. It'll be on December 12th when it'll come out. So be ready for that. Obviously, I'm going to do a video on it when it comes out. And then very same day that report comes out, the Fed will be meeting. That'll be day one of their year-end meeting. This is their last Fed meeting for 2023, right? And then 23 is going to be in their rearview mirror. So those two key things are happening next week. And as investors, we really got to be paying attention to that, guys. I will continue to back that up and say we got to pay attention to that if we're going to be good investors. If we're going to be the type of investors who gather information so that we know how to pivot when it comes to building our wealth. If we sit around and we never pay attention to this stuff, guys, we're not going to be very good investors. If we only sit around and pay attention to the talking heads on the major news networks, right? The major financial news networks. If we only listen to those people, we're going to be in trouble, because you obviously know those people work for the 1%, right? Their salaries are paid by the people who run the network. And those network people, those execs, shareholders, or major shareholders, I'm not talking about our little 25% retail shareholders. I'm talking about the major shareholders, the institutional shareholders, the billionaire shareholders, the billion-dollar hedge fund shareholders. Those people have a vested interest in keeping us, the general population, not knowing what's going on, because they make their money off of us, right? So we got to be careful of just listening to them. We got to get out and listen to this data and kind of dissect it, and then come up with a strategy to be able to invest and do well no matter what the data says. And that's the strategy I use. I use a strategy that I don't care what the data says. I'm going to keep buying, because I know every bear market is followed by a bull market. At some point in the future, the bull market's coming. My goal is to continue buying until it gets here. So, yeah, I want to know what the reports say so I know how to move and pivot. But until that next bull market gets here, my objective is buy, because we're still in a bear market, right? We've had a bear market bounce over these last several weeks, and we had it in November, right? That's been a bear market bounce. That's been a bear market rally. The real deal ain't gonna get here until the Fed start reducing short-term interest rates. So please know that. No matter what type of rally we have right now, it's just a bear market rally. The real bull market rally won't come until the Fed start reducing short-term interest rates. And I believe that's sometime in 2024. Again, that's just my opinion. You guys have to go out and do your own research, do your own homework, come up with your opinion. But my opinion is exactly what I just gave you. Guys, if you want them 12 free stocks from Webull, you got to click on that link. I have an affiliate link down in the description box of this video. If you're interested in getting up to 12 free stocks from Webull, then go ahead and click on that affiliate link down in the description box of this video. When you open up your new Webull account, when you fund your new Webull account, they're going to give you up to 12 free stocks for just trying out their brokerage app. I use the Webull app every single day, guys, to buy paper assets, to sell paper assets. And I've been using it for almost 3 years. So I would never ask you to try something that I wasn't using. So if you're interested in that offer, again, affiliate link down in the description box of this video. Well, guys, let's go ahead and wrap this thing up, and I'm gonna let you guys go. I'll be back this afternoon with a longer live stream this afternoon or early evening. It'll be on a different topic, but obviously it'll be around financial literacy, financial education. I appreciate y'all stopping in on this one. Just wanted to give you a quick update. As soon as the data came out, wanted to give you this information on the jobs report, because I know for a lot of you guys, I'm one of the sounding boards. I'm one of the people that you listen to, and I wanted to give it to you the way I interpreted it. Now, you're more than welcome to go out online and do your research on this latest jobs report and see what you think of it. But I wanted to give you what I thought of it, because that's what I do on this channel. I give you guys my opinion. It's not a convince you channel, it's an opinion channel. And that's all I just gave you, my opinion on what I believe this November jobs report means for what the Fed is going to be doing going forward. That's all it was. You go out and do your own, like I said, fact finding, come up with your own interpretation of it, and you'll be good to go, right? Also, wanted to make you guys aware of next week. November CPI inflation report coming out on December 12th. It'll come out at 8:30 a.m. Eastern time. Be ready for it, guys. And of course, I will come in with a video to give you guys my interpretation of that data. That's all it is. I'm no expert. I'm just giving you my interpretation. And simultaneously, the Fed will be starting their year-end meeting. Their last meeting of 2023. It will start on December 12th. And it will conclude on December 13th. And on December 13th would be the day they will announce whether they are going to increase short-term interest rates, do nothing with rates, just keep them the same, or reduce. No one believes they will reduce, right? Nobody. Everybody believes they will keep them steady where they're at. That's what the market is predicting. That's what the experts are predicting. No one's really predicting they're going to increase them. Could they? Yes. That's the reason why you need to be paying attention, so you know firsthand, right? So please pay attention to those two pieces of data and meetings that will go on next week. It's a big part of how we move and maneuver as retail investors, right? That way we're not just listening to the talking heads on these major financial networks that are being told what to say by the 1%. And they want to keep us off balance. The 1% wants to keep us off balance because they use us to make money. They don't want us to know the truth about our financial system and how it operates, because then they won't be able to manipulate us to make money off of us. So you got to get your own information and then figure out what direction you want to go when you get the information, not somebody else giving you the information and trying to sway you one way or the other. My channel is not about swaying you one way or the other. My channel is about just giving you my opinion as a retail investor just like you. This is my opinion of what's happening, and this is the direction I'm going. That's the only purpose of my channel, and to get you to think. All right, guys, hit that thumbs up. I'm getting ready to get out of here. Like I said, I hope some of you guys tap back in later on this afternoon. I'm gonna have another live stream where I'm gonna be covering different content, but it's all gonna be financial related. So hit that thumbs up for me before you get out of here. I really would appreciate it. Thank you guys for stopping in for a few minutes here on this Saturday, on this Friday morning. I'm getting ahead of myself. On this Friday morning, I really appreciate it. Again, if you want them 12 free stocks from Webull, go down and click on that affiliate link in the description box and sign up for Webull. Put you some money in the account. They're going to give you up to 12 free stocks for just trying out their brokerage app. Also, guys, if you don't mind, share this video with somebody that may not have been on the live stream, that may have a vested interest in know what's going on with the jobs report from a layman's standpoint. I'm certainly not an expert, but just the layman's standpoint. Just thought I'd give you my feedback and my opinion on it. Thoughts become things. If you can see it in your mind, you can hold it in your hands. You guys keep chasing your greatness. Never stop believing in yourself. And I'm going to catch you on the next video. Peace.